Welcome to another podcast of the Riffle series. The Riffle podcast series brought to you by 10 Leaves. Today, we are doing a deep dive into, well, what you could call the nerve center of global reinsurance regulation. You, our listener, shared this with us. It's the Financial Services Regulatory Authority's discussion paper number 1 of 2025. That's the FSRA of the Abu Dhabi Global Market, or ADGM.
And it's a big one.
It really is. This paper is proposing a fundamental ground-up overhaul of its rules for insurers and, what's really key here, for reinsurers. So our mission today is to get to the so what. How is one of the world's most ambitious financial hubs trying to strike this incredibly difficult balance?
You mean being globally competitive and attracting huge amounts of capital?
Exactly. While at the same time maintaining these rock-solid, rigorous risk standards. I mean, they're essentially trying to leapfrog existing frameworks, which is a huge strategic play.
It's a massive strategic move, and it really reflects a crucial transition happening, across the entire global insurance industry.
We're not just tweaking things.
Oh, not at all. The FSRA's goal isn't just to update, it's to fundamentally redesign. They're explicitly aiming to adopt the most effective, risk-sensitive parts of international framework.
Things like Solvency II or the Swiss model.
Exactly, like Solvency II or the Swiss solvency test. But, and this is the key, unencumbered by the decades of legacy rules that can really bog down older jurisdictions.
The insight here seems to be that ADGM is building the system of the future right now. They see that the industry has structurally changed.
Absolutely. The driving force is this global move towards economic capital-based approaches. It just means your capital requirements are tied directly to the actual measured risks.
Not just old formulas.
Not at all. And they're directly addressing today's challenges, from the growing complexity of derivatives all the way to the dominance of private capital in insurance. This paper is the blueprint.
Okay, let's unpack the core mechanism here, because it all starts with a new way of calculating capital. They're moving to what they call the ADGM Solvency Capital Requirement, or ASCR. What does that new foundation look like?
Well, the ASCR is designed to be highly risk-sensitive. The whole point is to make sure the capital an insurer has to hold aligns, precisely with the underlying risks they face.
So we're talking about
underwriting risk, market risk, counterparty default risk, operational failures, and, critically, how well their capital can actually absorb losses.
And how is that risk? How is it quantified? It seems to move squarely into pretty advanced statistical modeling.
It does. The ASCR is built on a value-at-risk approach. VAR.
Okay, VAR.
Conceptually, VAR calculates the maximum loss you would expect your portfolio to incur over a one-year time horizon.
But with a very high confidence level.
Very high one, say 99.5%. It gives you a number that, in theory, should only be breached 5 times in 1,000 years.
So it's a great standard metric, but it's kind of notorious for ignoring those catastrophic tail risks, the really rare massive losses outside that 99.5%.
Precisely. And that's why the FSRA isn't just dictating VAR. They're actively asking the industry for feedback on alternatives, specifically tail value at risk, or TVR.
How is that different?
Well, unlike VAR, TVR doesn't just stop at that 99.5% line. It looks beyond that point, and it averages the expected losses way out in the tail. So it's generally seen as a more conservative and robust measure for true catastrophe risk.
That inquiry alone shows they're focused on robustness. But here's where the strategic angle for ADGM really comes in. Competitiveness. The new ASCR explicitly recognizes diversification benefits.
And that is the key insight. If you're a global conglomerate looking at ADGM, this is what you care about. They aren't penalizing complexity, they are rewarding sophistication.
So if an insurer is diversified across different geographies, different products, say life reinsurance and property cat risk.
The ASCR calculation assumes those risks won't all go wrong at the same time.
Which means the overall aggregate capital they need is lower than if you just added up all the individual risks.
Exactly. So if you're a massive, globally diversified firm, that means greater capital efficiency. It's a significant competitive advantage to base your operations in ADGM.
It really favors the big, integrated players who have the profile to genuinely diversify.
It does. And the paper sets some very clear supervisory guardrails around that efficiency.
Right. They define these operational thresholds for capital. The standard target is 120% of the ASCR.
Yes. So you need a 20% buffer over that minimum. But to maintain the safety net, they mandate a higher threshold, say 150% of the ASCR, for entities they see as higher risk.
Like a new startup.
Think of a newly established insurer, one that lacks a strong global parent, or maybe one that's focused on a particularly volatile line of business. They need a bigger cushion.
And if those thresholds get breached, they have a clear intervention plan?
They do. The FSRA is setting up a comprehensive, they call it a ladder of supervisory tools. So it can move from gentle nudges like requiring a remediation plan for a minor breach,
All the way up to.
all the way up to regulatory imposition, or even pulling their license for severe breaches of the absolute minimum capital requirement, the MCR. The response is swift and proportionate.
That discussion on the ladder of intervention, it leads us right into the next big topic. Flexibility in risk modeling. The framework isn't just one size fits all.
That's the multi-tiered approach.
Yeah.
The ASCR is a standard formula, sure, but the FSRA recognizes that often the best measure of risk comes from the firm itself.
Which is where internal models come in.
Exactly. So instead of relying on the parameters set by the regulator, a firm can use its own proprietary Model 1 that's tailored precisely to its unique mix of risks to calculate its regulatory capital.
But I assume that's subject to some pretty rigorous approval.
Oh, absolutely. This mirrors leading jurisdictions like Switzerland with its SST or Bermuda's BSCR. An insurer can propose a full internal model, a partial one for specific risks, or even use an approved off-the-shelf vendor model. It encourages a much better culture of risk management.
And that sophistication has to align with the global consensus.
It must. The internal models have to align with the IAIS Insurance Capital Standard, or ICS. That's the global yardstick. ADGM is making sure it speaks the same language as every other major financial center.
So beyond calculating how much capital is needed, they're also updating the structure of the capital itself, the own funds.
Correct. This is the move to a tiered system. Again, it's familiar if you know international concepts like Solvency II. It enhances transparency and really the quality of capital. It's divided based on permanence and its ability to absorb losses.
Okay, so Tier 1 is the most robust.
Right. Think of Tier 1 as permanent, plain vanilla common stock, the highest quality, most loss-absorbing capital there is. It can be used without limit to meet the ASCR.
Then Tier 2 is more restricted.
Limited to 50% of the ASCR. This includes things like subordinated debt, instruments that are only senior to what policyholders are owed in a liquidation.
And Tier 3 is the most restricted, capped at just 15% of the ASCR. Why so low?
Because Tier 3 capital, so things like preference shares or deferred tax assets, it's really the lowest quality. It has the least permanence and the weakest loss absorption. By capping it at 15%, the regulator makes sure the vast majority of an insurer's buffer is high-quality, reliable capital.
All right, let's shift gears a bit. Let's talk about innovation. Because this framework isn't just about compliance, it's about enabling new market structures. And the synthetic sidecar is a crucial, pretty high-tech instrument they want to enable.
The synthetic sidecar is, well, it's really ingenious. Traditional sidecars are separate, fully capitalized companies created just to hold a slice of risk.
A whole separate legal entity.
Right. Synthetic sidecars achieve the same goal-transferring risk to capital market investors, but they operate within the existing insurer.
The paper draws an analogy to a covered bond. That helps a bit.
It's an excellent comparison. In a covered bond, your repayment isn't secured by the general credit of the company, but by a dedicated, ring-fenced pool of assets.
And the synthetic sidecar works the same way.
Very similarly. Capital from investors is paid into a legally charged, isolated account within the insurer. That pool of assets is ring-fenced, securing the investor's position.
So you transfer the risk without all the heavy administrative lift of setting up a whole new company. How does the loss absorption actually work for the investors?
It uses a loss-absorbent instrument, often preference shares, that is linked to a specific portfolio of the insurer's liabilities. If that portfolio takes losses that hit a certain trigger.
The preference shares get written down?
Exactly. The insurer's obligation is reduced, and the claims are effectively paid from that ring-fenced capital. It's transparent, fully funded, and a much more cost-effective way to raise collateralized reinsurance capacity.
And this ties directly into ADGM's broader push to support the insurance-linked securities, or ILS, market locally.
Yes, instruments like catastrophe bonds transfer risk entirely to the capital markets. This increases global reinsurance capacity, and it diversifies funding away from just the traditional reinsurance providers.
And that's a big market.
It's huge. The global ILS market hit over $100 billion by the end of 2024. Attracting even a small slice of that flow is a significant economic boost for ADGM.
And speaking of capital and assets, this is where the innovation meets the very edge of modern finance. The FSRA is looking at expanding the range of assets insurers can hold.
Right, through the asset liability matching approach, or ALM. They're considering a matching adjustment. This is an allowance you can get if you can show a really tight match between cash flows from your assets and your future liabilities.
What does that allow?
It allows a much broader spectrum of assets to be eligible. We're talking private credit, infrastructure, real assets.
But the truly fascinating question posed in the paper is about allowing digital assets.
Exactly. The FSRA is actively considering allowing accepted fiat reference tokens, FRTs, and other approved virtual assets to be used in ALM.
Wait, really?
Yes. And because ADGM has already positioned itself as a leader in regulating digital assets, this could be the first time a major reinsurance hub explicitly allows these assets, provided, and this is crucial, they are matched to corresponding liabilities. It's positioning them years ahead of many other regulators.
If we take a step back and connect this to the bigger picture, this whole revamp isn't happening in a vacuum. It feels like a direct response to global systemic risks, many of which have been flagged by the Bank for International Settlements, the BIS.
That's the systemic lens. A major concern globally is the increased use of derivatives, especially interest rate swaps, by life insurers.
To hedge against market volatility.
Right. But while that helps with solvency risk in one area, it introduces a whole new liquidity risk.
From the constant need to post collateral, meet margin calls, especially when rates are rising fast.
And if rising rates happen to coincide with a period where policyholders are surrendering their policies, maybe to chase higher yields elsewhere, you get a double whammy.
A massive liquidity drain.
Exactly. A drain for margin calls and a surge in payouts. The FSRA is looking at requiring probabilistic assessments, risk sensitivity analyses, maybe even demanding higher capital buffers for firms that rely heavily on dynamic hedging strategies.
And then there's the perennial duration gap problem, the mismatch between long-term liabilities and the assets you hold to cover them.
It's a classic problem. Long-tail life insurers need assets that mature decades in the future, which are scarce. Conversely, short-tail non-life reinsurers can sometimes end up holding assets that are too long for their needs.
So what's the proposal's fix?
It offers a very pragmatic flexibility point. If liabilities can be settled in specie, then a wider portfolio of assets is acceptable.
Explain in specie settlement. What does that mean in reality?
In specie is Latin for in its own kind. It means you settle a liability not with cash, but by transferring the underlying assets directly.
So you could pay out a claim with a piece of a real estate fund?
Potentially, yes. If the contract specifies that the payout can be made by transferring a share of the investment portfolio, a piece of a fund, or even a holding of these approved virtual assets, then the liquidity risk of having to sell that asset quickly to get cash is mitigated. It's key to enabling the use of less liquid assets like private credit.
That's a powerful tool, but it raises a question. As private capital pushes insurers toward these alternative, less liquid, riskier assets, how does the regulator ensure safety?
With robust safeguards on expertise and valuation. For specialized or unrated assets, the FSRA suggests that the insurer must have demonstrably appropriate in-house expertise.
And if they don't?
Then they might be required to partner with an FSRA-authorized investment manager, or to ensure fairness in the capital calculation.
They could mandate independent validation.
Precisely. If an insurer is using its own internal ratings for these complex assets, the FSRA can require an external, independent third party to come in and verify those ratings. It ensures sound practice without killing potentially profitable investments.
One final structural piece. They are considering permitting composite reinsurers. That's a big deal.
It is. That means underwriting both life and non-life reinsurance in the same entity, which is a departure from many older systems. They argue, and I think compellingly, that combining these portfolios provides diversification that actually enhances solvency. The risks are typically uncorrelated.
And of course, the paper stresses robust group supervision, which is essential for these global players.
Absolutely. The focus is on effective group-wide governance, transparent monitoring of intra-group transactions, and making sure the capital, the owned funds, is genuinely fungible and transferable across the whole group. Solvency has to hold up everywhere, not just on paper in the ADGM branch.
So let's try to wrap this up. If we boil it down, we have three main pillars in this overhaul.
I'd say so.
First, a strategic shift to risk-sensitive capital, the ASCR, using a sophisticated VAR or even TVR approach that rewards diversification.
Right.
Second, structural innovation, enabling highly efficient vehicles like synthetic sidecars and building a local ILS market.
Yeah.
And third, this enhanced asset flexibility through ALM, and the really modern consideration of things like accepted FRTs and approved virtual assets.
And the relevance to you, the listener, is that the FSRA isn't just, ticking boxes. They're designing a framework for superior capital efficiency and greater flexibility, all while offering stronger policyholder protection through better risk calibration.
They're clearly positioning ADGM as a premier, forward-thinking reinsurance hub.
They are. Which brings up a really important question for the future, I think.
Hey, go on.
Given this global trend toward risk-sensitive frameworks like the ASCR and encouraging innovation like synthetic sidecars, how might the adoption of approved virtual assets in insurance portfolios fundamentally change the very definition of acceptable risk and long-term liquidity for global regulators everywhere?
That is certainly something to ponder.
It is, especially as the FSRA plans to release more detailed consultation papers throughout 2026. And remember, the comment period for this initial discussion paper closes on February 16th, 2026.
We encourage you to keep diving into those details. That's all for this deep dive. We'll see you next time.